Welcome back to Financial Statements for Beginners. This time, we will look into income statement. An income statement, also called Statement of Financial Performance, shows the company's revenues, expenses, and net income over a period of time. It is also called Statement of Income or presented through the Statement of Comprehensive Income. Revenue is the value of all sales of goods and services recognized by a company within a specific period. Revenues are located at the top section of the statement. It is a cash inflow to the company coming from sales made from normal business operations. But what is considered normal business operations? They are regular activities a business undertakes to fulfill its core purpose. These are the essential activities of the business in order to function and generate profits. Here are examples of revenues, which are different from company to company. Selling residential units is considered revenues for a real estate developer, but not for a mining company who sells their employee housing properties. Interest income is considered revenues for a bank, but not for a retail store who may have earned the same income from a time deposit. Selling cars is revenues for an automotive company, but not for a power company who sells their company-owned vehicles. Now let's move to expenses. An expense is a cost that a company incurs to generate revenues or maintain its operations. Expenses are found in the middle section of the income statement, right after revenues. It is basically the cost of doing business, which results in an outflow of cash or other assets. The basic classifications are direct cost and operating expenses. Direct costs are expenses that can be directly traced to a specific product or service. They are direct materials, direct labor, and direct overhead, which are expenses traceable to the production of goods or services. They are presented as cost of sales or cost of goods sold. Operating expenses are the day-to-day cost of running a business other than direct cost. This covers a wide range of expenses from advertising, insurance, legal fees, office supplies, and salaries, among others. They are usually presented as one line item in the statement as operating expenses or as general and administrative expenses. Net income represents the profit that a company earned after deducting all its expenses from its revenues. When expenses are more than revenues, it is called a net loss. But wait, before reaching the net income, there is a section in the income statement for other income and expenses. These are P&L items that are incidental to business operations, like interest income and interest expense, foreign currency translation gains and losses, share in the net earnings of associates and joint ventures, and all other gains and losses that cannot be classified under operating revenues and expenses. Lastly, there's income tax. This is the last deduction in the income statement before reaching the bottom line net income. Now let's dive a little deeper. The formula for net income is operating revenues minus operating expenses to get operating profit, plus other income, and minus other expenses to get earnings before tax. And lastly, deduct tax to get the bottom line net income. But there is another income statement presentation that is widely used. The formula starts with operating revenues minus direct costs to get gross profit. Gross profit measures how efficiently a company manages its production costs. From gross profit, operating expenses are deducted to get operating profit, plus other income, and minus other expenses to get earnings before tax, then deduct taxes, and it should bring you to the net income. But here's a question. Do all cash inflow and outflow go to profit and loss? The answer is no. Some of them goes to the balance sheet. So how do we know if it is a P&L item or a balance sheet item? The general rule is, if it is earned and incurred during the period, it should go to P&L. If it is a non-capitalizable expense, meaning it is low cost with a short lifespan, it should also go to P&L. On the other hand, if it is not yet earned, or not yet incurred, or if it is a capitalizable expense, then it should go to the balance sheet. Let's do some examples. A property leasing company received 50,000 pesos as payment for the current month's rent. Should this rental revenue go to P&L, or should it go to the balance sheet? It should go to P&L because it is payment for the current period, which means it is already earned by the company. But what if the leasing company received 100,000 pesos as payment for the current month's rent and next month's rent? Should this go to P&L or the balance sheet? 50,000 should go to P&L because the current month's rent is already earned, while the remaining $50,000 should go to the balance sheet as unearned rental income, since this is payment for future rent. Thus, it is not yet earned. Here's another example. A company paid 300,000 pesos for property insurance covering the full year. Let us assume this was paid in January, and we are still in January. Should this go to P&L or should it go to the balance sheet? 25,000 should go to P&L in January, because this is the monthly equivalent for the insurance paid, and this portion is already incurred in the current month. The remaining 275,000 should go to the balance sheet as prepayments for a future expense. For each of the succeeding months, 25,000 will be expensed in P&L, and prepayments in the balance sheet should decrease accordingly. Here's one last example. A company purchased a car for its new manager, which cost 1.5 million pesos. Should this go to P&L or the balance sheet? A car is capitalizable because it has a lifespan beyond 1 year, and the amount is material. Initially, this would go to the balance sheet as property, but this will be depreciated over its useful life, and the amount of depreciation will go to P&L. Thank you for watching. If you liked this video, please like or subscribe to my page and channel. See you on the next one.